remember, when a sector goes through a process of derating, you cannot put your finger at this is the right price, this is the right P multiple, that is a wrong P multiple, it has fallen 30%, it will not 5%. No, that's price which will play, tricks with you. When a market goes through an expansionary phase, or when a sector goes through an expansionary phase, the P multiples and the price to book, it gets calculated higher and it goes disproportionately higher. Mean reversion would kick in, and then the mean reversion is also coming along with earnings decline. So you don't know what the right level is. NBFCs will start contracting their books and their perceived P multiple will come down. And I don't think you can really find a middle path here. The way to analyze this kind of a market is that don't get into prices, buy a good business, sit on it for 2, 3, 4, 5 years, and then trust me, market will do the magic. There is no point in trying to guess just because the stock has fallen 10%, it will not fall another 10, and 30% is the maximum decline which you will get in a stock. That's not going to work in this kind of a market. Aashish Somaiyaa, good morning. Thank you for joining us. Now, Aashish, as a house, you represent a portfolio which was always centered around quality. It was always high P or high price to book, but it had a promise of growth. But is the basic growth assumption getting challenged now with the kind of stocks which you have invested in, or kind of holdings which your fund managers currently have?
So if you actually see what are our, amongst our say flagship funds, what are our top sectors? It's basically private sector banks, insurance companies. We have a bit of say auto, white goods, consumers, oil marketing companies. Of course, we've taken a bit of a knockout there, but these are the key ones. Of course, there is IT and a bit of we're never into the deep end of infrastructure or cyclicals, but we do have some amount of linkage with say capex. So this is where we are in terms of our sectoral allocations. In terms of NBFCs, basically in our portfolios we had mainly HDFC and Bajaj Finance, and the rest were either not there or they were marginal exposures really. So I think we have to see the result season play out as it shapes up now, but so far I think things are holding up.
Aashish, hi, morning. So how challenging is it getting for your fund managers to deal with all the questions and deal with all the anxiety which I guess must be prevalent in the market and your investors right now?
I think, communication is always a key task of what we do in terms of maintaining transparency, maintaining line of contact and maintaining the communication. I think that is something which is critical. I think in the last 9 months, if you really ask me, the market behavior in terms of what is good, what is bad, what is quality, what is not, is pretty indiscriminate if you really ask me. And I am banking on this result season and maybe the next one for some amount of choosiness or some amount of discerning behavior to come back in the market. And if you really ask me, last year or so has been challenging on two fronts. Of course, there are errors of omission and errors of commission. Errors of commission are widely tracked, but errors of omission also is because of the way the index itself has behaved. A good part of the movement was centered around few stocks, some of them cyclicals, of course, and from our perspective, we don't find those fitting with our investing philosophy. So we would rather, we typically hold stocks for more like 4 or 5 years. So we'd rather wait through a time correction rather than making dramatic changes. So that's how we are looking at this. And I think from here on, my sense is that we would see significant amount of outperformance. Like I said, I expect the market to be a bit more discerning, and that always suits us.
Now, Aashish, it's in the public document that one of the largest holding is Page, followed by Bajaj Finance, iShares. I could be mixing up in terms of one or two names here, but that's the heart of your market. High quality at good price. Yeah. Is the market terrain forcing you to rethink some of your core investments? And let me explain my question here. Interest rates are going higher. That could have an impact on credit cycle. Yeah. That could have an impact on demand. So the basic delta with some of the companies which you own currently enjoyed because of low interest rate regime, if that is changing, will your portfolio approach also change?
No, I think that if you see, if there is of course there is a sense of interest rates going up, and that always results in some amount of PE compression. But when you look at quality and when you look at growth oriented companies, what you're banking on, look at it this way, that when you have quality and when it is relative to the market, even if it is relative to the market, if it grows better and these are quality businesses, The worst outcome for you is a time correction, and eventually, 2-3 quarters down the line or a year down the line, the earnings would act as a backstop. But if you're not in quality, and if you're seeing huge disappointments in growth, then I don't think even a concept of backstop really works. You can actually have huge capital corrections. So the way I see it is that if we are with our kind of strategy, the worst outcome is that you hold a bit longer. But there are more high beta or more riskier strategies where the worst outcome is a significant capital correction if you get it at the wrong end of the cycle. So at least we are, like the examples that you're giving, for example, last quarter Page had, I think, a 22% volume growth and a 40% PAT growth. Similarly, if you see other consumer businesses, how their results are shaping up. I mean, FMCG businesses are seeing double-digit volume growth. And whatever we are hearing of the rural economy and the election spend and all those things, I don't think that is under severe questioning, at least at this point in time. As far as the private sector banks are concerned, I think right now a lot of financials are under a cloud, but all financials are not NBFCs. We don't have very high, we had no exposure to the DHFLs or Indiabulls of the world. So the point is that I think we would stick to quality, and I don't see, for example, why private sector banks and insurance companies need to be smashed by say 30-40%. In hindsight, one can say that yes, they were expensive, but I don't think one can make a case that they're embroiled in whatever is happening right now. In fact, with some lag effect, private sector banks will see their market share and their business momentum because last 2 to 3 years, a lot of business moved out of the banking system into the capital markets. Instead of putting money in banks and banks doing the lending, people started putting huge money in mutual funds. For example, debt mutual funds, in last 5 years, it moved from 4.5 lakh crores to 16 lakh crores in terms of corpus. So debt mutual funds saw a huge inflow. They started lending to NBFCs and financial institutions, and that's where the credit got completed. But now if you see private sector banks, on the liability side they are back, and on the asset side also they are back. So with some lag effect, right now everything is under a cloud. That's why I started by saying that market is being indiscriminate. I think if we keep some patience, we'll see significant outperformance.
Ashish, the exposure to NBFCs among mutual funds was fairly significant 2 years back, and the premise was that you're going to hold them for it's a long-term story, 3 to 4 years, as you pointed out, being the time horizon for conviction there. And now, after what's happened over the last 6 months, there is a fair amount of nervousness on whether or not one should buy this fall. What is the approach that you're taking at Motilal Oswal Asset Management, amidst this NBFC turmoil?
Yeah, so I mentioned a couple of large names which we do have currently in our portfolio, and the others are marginal right now. But I accept the point that a year back, year and a half back, couple of years back, we had significantly higher exposure. And I think beginning somewhere middle of last year is when we started reducing it dramatically. I'm talking in general across our PMSs as well as our mutual funds. So, and I think a couple of them even indicated that there is an issue with the asset quality, and a couple of them even indicated that they would like to slow down in terms of their growth. And those stocks got knocked down first. So we read some signs, and we were not zero, but we had much dramatically reduced kind of exposure. So on your question, and right now we don't hold any of the names which seem to be embroiled. On your question, say the DHFL, Indiabulls, etc., we have always had zero exposure. We didn't have any of those stocks at all, since our inception. So we've not had exposure to the aggressive names really. We've had exposure to more of the hardcore mortgage related names. That is one. And second is, I do accept your point that in the last 3 to 4 years, 5 years, like I also mentioned about the mutual fund statistics, because of shift from banks to capital markets, for their own reason, banks have not been growing, and as a result, a lot of the activity shifted into capital markets, and that's where it was believed that NBFCs have a great highway to go forward. But I think the events of the last 2-3 months, coupled with the showing up of asset liability mismatches and coupled with rising interest rates, I think definitely some of the hypothesis has gone for a toss. It's not playing out as was originally anticipated. But I would still like to say that, I would like to say that we actually read some of it slightly early on, and our exposures were pretty much negligible by the time we came up with the scenario.
Why, Ashish, in this fall? The temptation to buy mid-cap stocks, small-cap stocks is very high when you see a 30, 40, 50, 60% fall. And human mind, it plays tricks. The first thing that comes to you when you see a fall that 50% girega aur kitna girega, let's be a contra buyer here.
Yeah, so by some accounts, I would still, I mean, I get your question, but I would still stick my neck out, and by some accounts, I would say that there is some small caps and mid caps have become attractive. The market mood may not favor them for another, say, couple of quarters or 3 quarters, or I don't know how long this persists. But we must accept that, ultimately over any 5-7 year time frame, if you buy the upper end of, the upper end of small cap, or if you buy good quality mid caps, they do end up outperforming. And after this kind of dramatic correction, anyway, sorry, dramatic is the wrong word, but I would say that there is fair amount of correction, and there are a few of them which are showing value. So I would not shy away from saying that some cherry picking can be done. Of course, the expectations need to be kept in check. And why I corrected myself on the dramatic bit is because most people don't seem to remember that in 2017, small cap index went up 57%. And from that level, this year it is down 35%. So if you do the arithmetic, it is where it was, say, a year and a half back. Now in the intervening period, which are the guys whose fundamental performance has held up is what you need to really look for.
So, Aashish, what is your understanding on the way how PMS flows are moving? We keep on getting all kind of mixed reports that PMS schemes is where the real concern is. The flows are dropping. What has been the experience at your end?
I think the net flow is still positive, and this is not something which is for me to claim. I mean, these are numbers which are published on the SEBI website. Only thing is that when you see this publicly available data, you need to be having some insights for you to segregate what is the impact of mark to market, and what is the impact of inflows and outflows. So definitely September was quite a bad month in the sense that the mark to market impact across portfolios was quite significant. So you would see a lower AUM. But if I were to genuinely report just the inflow minus outflow, then it is still net positive. Definitely the volume of inflow has declined compared to what it used to be, say, 6-9 months or 12 months back. But if I actually do redemption, inflow minus outflow, we are still net positive.
When you say genuinely report, I'm trying to understand.
I think these are typical market cycles.
When you say genuinely report, I'm just trying to understand that.
No, I am responding. No, I am responding to how you put the question, because there is a belief or there is a feeling that there are outflows. And that's why I was trying to clarify to you that a lot of times the AUM number, we have 15,000 crores of assets, and let us say in a month the value drops by say 7-8% or 9%. Then on 15,000 crores, we would lose 1,000 crores by way of mark to market. So what would come across is that there is a decline in AUM, but that's part of the game. That is equity, so mark to market can happen. When I said genuinely report inflow and outflow, I meant that you keep the mark to market aside and just focus on how much money we receive and how much money we pay out. The number is net positive.
Really and factually, that's the view that you're sharing. But Aashish, very quickly on earnings, right? You spoke about NBFCs and the approach there. You said IT earnings have mostly been in line with expectations. Do you feel like out of all the earnings that you've seen thus far, that it's indicative on how Q2 may not be as bad as one was anticipating because of the currency fall, because of what was happening with oil prices and rates going up?
No, it is. No, it is. There is a bit of. It is going to be a bit unfortunate. The reason being that we've been waiting for earnings to look better. And on your question, our sense is that yes, Q2 earnings will look better than what Q1 was or what it has been in the past. But the fact is that people would still like to see how the next 2 quarters shape up, because in the background, so many things have happened. And will we, even if we see a good Q2, in certain pockets people will have a worry whether Q3 and Q4 will sustain or not. So definitely, Q2 numbers are looking better than what it used to be in the past, but then people would like to caveat it and be a bit choosy and see which parts of this is going to sustain forward. It's very clear that some of the financials or some of the interest rate sensitives or the guys who are heavily say leveraged, some of those guys or some of these NBFCs, for example, you're selling down your portfolio. At what yield are you selling down? How is it going to impact the NPA levels on the residual? or for example real estate firms, how is this going to impact them, how is it going to impact the demand. So, and oil prices, will it impact auto demand? So some of these things one has to caveat, because we don't know whether Q3 will shape up as well as Q2 or not. So there are a bit of clouds right now, no running away from that. But on your specific question, I think this quarter is looking better than what it has been in the past.
Okay, Aashish, good to have you on the show. Thanks so much that you could take time out and speak with us, and good to get in that assurance that PMS flows are still in the positive, lest the market tends to believe that you're already seeing some massive redemption pressures coming in. Glad that you could clarify that fear.